Palisade Radio is brought to you by First Majestic Silver Corp, one of the world's purest and fastest growing silver mining companies.
Welcome back to another episode of Palisade Radio. This is your host, Colin Cattell. As always, thank you for tuning in, and today we are speaking with Matt Geiger, manager of MJG Capital, which is a commodity resource-focused fund set up as a limited partnership. Matt, welcome to the program.
Thanks for having me today, Colin. First time on the show, but I'm looking forward to keeping in touch going forward. And, we have a lot to talk about here.
Yeah, well, just so our audience knows, you're only 24 years old, so very young like myself, but already quite accomplished. In fact, not only are you managing the resource fund, you also have a tech startup, which I believe is right now valued well into the 8 figures. I just want to get a bit of background on what brought you into the resource space, and you can talk about your tech startup as well.
Sure. Well, grew up in Silicon Valley, which is a bit of an anomaly in this space. Ultimately, I'm a risk taker, so I understand the things that can occur if you take risks, raise money. That occurred in tech first for me. I left college after 3 years when we raised venture money for a startup that I'm still working on currently. We've raised up to $10 million currently, and that's helped seed fund part of the partnership, as well as 15 other investors or so. Partnership-wise, we're focused on about 17 to 18 companies currently. We're 70 to 80% metal focused, and then 20 to 30% soft commodities. So that could be water rights, aquaculture, forestry, agriculture, the like. So there's a full resource mandate. We did launch in late 2011, so the timing has been very poor. We did tiptoe into the space, but as we've seen, this bear market's lasted for 5 years at this point, and anybody that's been involved for that whole period has felt the pain. That said, all investors are committed for the long term. One of the stipulations for the partnership is a 10-year lockup. So we do have the cash through a minimum of 2021, and we're going to keep deploying it. New investors are joining, even though the pace has understandably slowed. But we will catch this next upcycle here flush. We understand that bear markets, as Rick says, are the authors of bull markets, and this has been such a doozy that 3, 4, 5 years from now, you have to be very, very certain that there's going to be really nice returns on the table.
Yeah, and if you're still going along right now at this point and you have money left relative to the rest of the market after 4 years of a bear market, you have done quite well, so congratulations on that. And today I want to pick your brain on your investment philosophy, ideas behind what you're investing in the resource space right now, favorite commodities. So let's start off with what you're calling your 5 lenses to analyze juniors right now, which will give a good framework for our listeners as to what you're looking for.
Sure. Thanks. Yeah, I'll jump right in here for working capital. This is the first thing we're looking at: working capital relative to market cap. That's the ultimate lens that we're focusing on now, given the struggles we've seen in the market and the fact that we personally think that we could see 1 to 2 more years of these lower metal prices, and that's what we're basing our projections around. Anything quicker would be positive. So this is to minimize risk. And all you're doing is looking at the amount of cash or marketable securities that the company has in the bank relative to their overall valuation. The closer those are to parity, the less risk you'll have. And currently, we're even looking at 6 to 7 companies that are trading below their working capital. So this is a way to minimize risk and stick around until things turn. Another thing to look at is prospect generators. So these are companies with low valuations, but juniors actively advancing properties that they own. So it's the prospect generator model that Rick Rule has preached for years. But there are literally companies that have implied project values in the low millions and senior partners that are spending 10 million plus on the project over the next year to advance it. So here you have bigger company footing the bills for you. You don't get to keep the entire project yourself, but you avoid dilution along the way. So this is a very good way to participate in resource upside going forward. Another is looking at risk-adjusted expected value. The idea that here's a project, it's not in production yet. For simplicity's sake, let's talk about $1 billion NPV here. and it's trading at a discount because it's in the development pipeline. But judging on its stage, whether it's PEA stage, PFS, DFS, you can discount that appropriately based off of the chances of success. And when you see a massive delta between where you expect it to be and where it actually is in the market, that's something to evaluate. So we're looking at a couple holdings where, sure, they're in the development pipeline, so they shouldn't be valued at their full NPV. But at the same time, they're valued for pennies on the dollar right now when we think they should be valued at 30 or 40 cents on the dollar. So that's an opportunity. Another place to look is after discovery holes. You can cut the risk of exploration, which is a massively risky business. I mean, the chance of success on a grassroots project are very slim. But if you basically screen out any companies that are currently exploring and only look at ones that have hit a discovery hole, quote unquote, that's a great opportunity to narrow your sights and get projects that are on the come up. A discovery hole is a bit of an arbitrary term, so it does take some geological knowledge or some friends in the business that can tip you in the right direction. And then the final option is to buy before an economic report, and ideally the first economic report. This too isn't a cut and dry science. You're going to be looking at drill holes and kind of the original discovery hole, and then the program where they're firming up the deposit before an original PEA. So at this case, you know that there's going to be economic deposit here, but the market has not factored that in, and you're basically arbitraging in the meantime. So these are 5 different ways to go at it. Honestly, right now we're focusing on the working cap to market cap, which is very basic. But if you buy multiple properties and multiple companies that are trading, basically below cash or right at cash, you can be sure that you're going to have very minimal downside as long as management is responsible and as long as they're actively trying to create value versus some of the G&A vampires that are out there and these shell companies that are going to bleed you dry. If you evaluate management properly, I think this is a great way to go right now.
Yeah, well, all very sensible metrics, and I think that you've broken those down in a very easy way to understand for our listeners. I want to ask you next about your favorite commodities. You've sent me a list of 5 of them. Can you quickly cover that? Sure.
I'll jump in really quickly. The first 3 are kind of more standard, and basically what I'm looking at here, it's very simple. In any commodity, if you have the majority of producers producing at a loss, you know that there's going to be serious changes in the future. And in the uranium market, in the platinum group metal market, even in the gold and silver market, Randgold's CEO came out recently, says he thinks up to 50% of gold producers currently are underwater. So when you're in this scenario, one of 2 things have to happen. Supplies to come offline or prices have to spike. And usually it's a bit of both. Supply coming offline first and then prices following suit down the line. So in the case of uranium, silver, PGMs, if you have a very low cost asset, hopefully in the lowest quartile, you're going to be fine. But if you're a marginal producer and maybe even the bottom half of the OPEX curve, you're looking at potentially shuttering operations. And when these operations are shuttered, they take a long time to come back online, even when prices rise. So for each of those spaces, you should be looking at the producers in the lowest quartile or development projects that are also in that same low quartile OPEX. So this isn't a very marginal strategy at all. It's looking at best of breed in all those spaces. But you can be very confident that the lowest OPEX ones are going to be coming to production. And you can be confident that there's going to be a lot of supply in the bottom half of the cost curve coming offline for both uranium, silver, and PGM. So that's one area we're looking. 2 other commodities that are a bit more disparate. One is phosphate. This is one of the 3 inputs into NPK, which is inorganic fertilizer. The other 2 are nitrogen and potash. And when you look at those 2, their abundance in the earth, particularly potash, is about 10x more than phosphate. So ultimately, I think both of these are good investments, and they're both contrarian investments right now, whether you're looking at potash or phosphate. But phosphate is 1/10 as rare, or 1/10 is prevalent in the Earth's surface. And hence, if you're going to be doing something for 10, 20 years, this is probably the more exciting mineral to be in if you're looking at NPK. And then the final one is sandalwood. This is a bit of a curveball, but I thought it'd be interesting to your listeners. This is one of the few commodities that I've been seeing recently that's actually going up across any of the spectrums, whether it's the softs or the metals. And another notable example, of course, is lithium. But sandalwood has been on a 20-year bull market of about 15% price gains, which is shocking. It follows a similar trajectory to almost wild fishing in the fact that there is tremendous natural supply of this wood from trees, mainly in India and in Asia. But that supply has gotten to the point where, because of regulations and just over exploitation, it's not online anymore. So there's still massive demand from older applications and also newer ones. And there are plantations in Australia currently that are trying to fill the gap. So that's a very interesting opportunity. We own one holding in the space called TFS Corporation, and I recommend people take a look at it if they're interested.
Matt, I'm looking over some notes that you sent me here, and you have identified some things, some shifts that have occurred from the bull market to the bear market. And I think it's safe to say that management often looks creatively at potential fixes to make things more economic in a bear market. That's one of the results of a bear market. And conversely, obtuse and sloppy work are often the consequence of a bull market. And one thing you've identified is that potentially new source of ore that used to be looked at as new mines are now actually being acquired and picked up by producing assets nearby to potentially high-grade ore or just to add more feed down the line. Can you talk a little bit about what you're seeing there?
Sure. Yeah, this is a common thing that happens in these bear markets. This isn't the first time. And basically the name of the game here is preserving initial CapEx. So you want to be able to get things into development in these environments with as little upfront money as possible. You have companies across the board in all continents that were pushing standalone deposits maybe 2, 3, 4 years ago, maybe even recently than that. And that said, these were deposits that would take hundreds of millions to be put into production, and that money is just not available in this market, particularly for potentially marginal ones. So what you're seeing is a lot of companies, and whether this is fact or fantasy remains to be seen for many of these, but they're pitching themselves now as a potential source for a nearby currently producing operation to either increase their grades, to increase mine life, or maybe a combination thereof. The net result for investors, particularly in those companies that are now saying this, is that there is probably a greater chance of success now, because this is a lot more feasible than raising the CapEx that was being pushed for 2, 3, 4 years ago. That said, upside will also be severely diminished because the existing producer is going to take a lot of the value that shareholders were anticipating. So it's a little bit of a trade-off, but I think you can make some good money here.
Very good. And the next question I want to ask you is a topic that's very interesting to me. In fact, we've had Rick Rule on an entire show just talking about this concept, and it's something he's deemed as optionality. We actually just wrote an article about it on Palisade Research. And companies like Exeter Resources, Tower Hill Mines, Chesapeake Gold, I could name a couple other. They all have this in common, and they're optionality plays. And you're looking at companies, the best companies, as either optionality plays or best of class. I want you to talk about the distinction there and what you see are going to be the results as the bull market picks up.
Sure. So this is a really important concept, and it's one that's misunderstood across the industry even. And it is the battle, I'd say. It's an ever-present battle between optional deposits and best-of-class deposits. So best-of-class deposits are those that I mentioned earlier, ones that generally don't take an extraordinary amount of capital to start up, and ones that, when producing, are generally in the lowest 25% of the cost curve. Those are ones that will make money at most commodity prices and will have larger margins than their competitors. That said, interestingly, in rising commodity environments, these are not the companies that have the most upside. Those that do are the optional or marginal deposits. These are usually larger, so bulk tonnage and lower grade in general. And what you'll see here is these deposits could be completely uneconomic at current prices. A zero NPV, or maybe even a negative NPV. That said, you shut your eyes for 3 or 4 years and then open them, and we're in a higher price environment. These very same projects can now jump into the hundreds of millions of NPV if you plug in higher commodity prices. So even though they're more risky, these optional projects do provide much more leverage. So as an investor, it's really up to you how you want to play this space. If you're more conservative by nature, you might want to look at the best of class names and understand that you're buying mines that are still going to make money even if commodity prices stay at this level or drop a little bit more. You're still going to be making cash flow. On the complete flip side, if you're more of a risk taker, and we see a couple of very smart minds across the industry going forward with this, with mineral banks, or the idea of a development bank, and buying projects for pennies on the dollar that certainly are not economic at current metal prices, but in the event of material or higher prices by the end of this decade, could be worth exponentially more than they are currently. So two different plays. Greater upside if you go for the optional names, but you're basically betting on a metal price rebound. For us personally in the partnership, we're splitting. So we're going for some best of class to ensure that we make money as we're going forward. And then we're looking at optional plays with low downside. So if you look at a deposit that can make money at higher prices, and then if you look at the company and their working cap to market cap ratio looks pretty reasonable, then this is a good way to preserve upside, but also know that you're not going to lose money if things don't work out.
Yeah, and to provide an example to our listeners, and a company I know you're familiar with, Chesapeake Gold, they have 18.5 million ounces of gold, 526 million ounces of silver, over 4 billion pounds of zinc, and their market cap's around 80 million Canadian. They have around 25 million in cash. And as Rick Rule pointed out in the interview that we did, one of the crucial pieces of an optionality play is that they have enough cash to weather the bear market. Otherwise, they're going to dilute, and you don't get as much optionality as a shareholder. So just incredible values right now.
Sure.
And
Seabridge, Nova Gold are other names as well, and you can buy ounces for very, very cheaply right now.
Yeah, just amazing time. I want to finish off by asking you about some of your favorite countries that you're looking at investing in right now, and why you like the jurisdictions.
Sure. Well, we like to take geopolitical risk. We do spread our portfolio, and again, we have around 17 to 18 holdings currently. So we don't take massively concentrated positions, and this is why we take some risk. Places we currently like. Argentina has to be on the top of the list. We own a couple projects down there. One is Golden Arrow Resources, Chinchillas project in the Jujuy province of Argentina. And then close by is Western Lithium's Cauchari-Olaroz project down there as well. What we've seen is the Kirchner era has finally come to pass after, I think, it was up to 12 years. And we have a new president coming in, Macri. Financial types, business types down there are extremely excited about what this holds for Argentina over the next 4 to 5 years. Surprisingly, I haven't seen a massive reaction in at least the two stocks that I mentioned. That said, I assume that people are rallying together money right now as we speak for Argentina-focused funds and partnerships, and we'll start to see that money deployed and coming into existence in the next 12 months. So a good place to look at. Another South American jurisdiction that's interesting is Ecuador. All the smartest names in mining are going right there right now, even though there's not much buzz. So we have the Lundins there with the Fruta del Norte deposit, and they're bringing that forward towards production. We have Mr. Ross Beatty down there working with Odin Mining and more of a grassroots approach. And then we have Sprott backing Cornerstone Resources, a small holding of ours, which has very, very prospective ground down there, and also an interesting JV that they're advancing alongside a third party. So that's a place to look. That's interesting as well. Pretty hostile mining regime over the past decade. That said, changes are coming into place. There's no guarantees that these changes will work out, but given the value that you're seeing there, it seems to be a good risk to take. And I think that these names going into that space vindicate it. And then the third, very quickly, Serbia right now, believe it or not, there is a lot of interest. And it does stem around one company currently, and that's Reservoir Minerals. They've been able to have two majors come in, and whether it's Rio or Freeport, and spend tens of millions, and it's going into the hundreds of millions of dollars at this point. Seems to be very, very underappreciated mineral endowment there, and we're just kind of realizing that these are world-class type copper gold deposits that are going to be exploited for some time. So whether it's getting involved through Reservoir or some of the few other ways to play Serbia, I think we're seeing a lot of excitement there as well.
Great. Well, Matt, if you have anything else to add for our audience, any advice, suggestions at this point on the market, and also finish that up with some information about your fund so that anybody who's interested can visit your site and reach out to you.
Absolutely. Well, thank you for having me on again, Colin. It's a great talk. Ultimately, you've heard our strategy throughout the interview. We're trying to play conservative here. I could see the market turning quicker. A lot of smart names are saying that this Q4 2015 is the final capitulation we've been waiting for. But out of conservatism, I think we should assume that there's going to be low metal prices for at least another 12 to 24 months. So in the meantime, buy companies with limited downside that still have competent management teams and exposure to higher resource prices and to the gains that those hold. In terms of the partnership, we're actively seeking investors. This is the hardest time to raise money, but it also is the time to raise money, and I would kick myself for not trying. So we are bringing LPs on. If you have any interest in exchanging ideas, getting in the email loop or talking further, you can visit www.mjgcapital.com. My contact information is there. I do a semi-annual letter every 6 months, and I've been doing that since the fund's inception. Those are all there. You can check out recent site visits. So, yeah, a lot of information, and I'd love to chat with anybody interested further.
All right, Matt, thanks so much for coming on the show. It was a pleasure.
Colin, appreciate it, and we'll talk soon.
Think you understand the junior mining sector and you think that the participants in the mining sector, junior mining sector, are good people and kind people, hit the bid.
And the world is always going to need raw materials. It's going to need copper and gold and nickel and so forth.
Totally destabilized. Hey, Troll, did you hear what's going on in Yemen, or are you too stupid?